Okay, welcome back. Today what I want to do is that I want to show you how to actually identify and create an arbitrage with forward contracts. Okay, so what we're going to do, we are going to actually take an example from lecture 6 and then implement the arbitrage here. Okay, so we're gonna get started with a very simple premises where we have the S and R, which is like slightly different contract than S&P, I guess. Spot rate is at $1,100. Okay, and then we also told that the interest rate is at 5%. And last, we are told that there is a forward, or futures, that makes more sense to think of it as a futures trade on an exchange, is trades at, and I think we are told a trade at something like 11.29. There's one last piece of information is that we are talking about a futures at 9 months. Okay, so maturity is really 9/12 if you want to think in terms of year. Okay, and the first question we're asked is, what is the dividend yield delta implied by the price? Another way of thinking about this question, say, can you solve for delta? We have lots of information here, right? We have S naught, R, F naught T, and cap T. Can we solve for delta? Well, let's see. There is one thing that we know, is that we know that we have a formula that links the forward price to the spot price. Okay, now let's replace what we do know and what we do not know. I know the forward price. I know the spot price. And what else do I know? I know the interest rate, 0.05. I do not know delta. And I know the maturity. Okay, well that seems like I have one equation, and one unknown. So I'm going to try to solve this. Okay, so first I'm going to put this 1100 and bring it on the other side. So I divide everything by 1100. So 1129 divided by 1100 is equal to exponential 0.05 minus delta times 9/12. Second step is I'm going to take the log. Don't forget that, that's the natural log. If I want to bring all of the exponents from exponential down, I'm going to use the fact that ln of exponential x is equal to x. Okay, so I take the log on the left-hand side, and that's equal to 9/12, 0.05, that's my interest rate minus the dividend yield. I'm going to multiply everything by 12/9, right? I'm going to bring those on the other side. Is equal to 0.05 minus delta. And now I'm ready to express delta as a function of things that I know. So I bring delta on the other side, and delta is equal to the interest rate, 5%, minus 12/9 ln 1129 over 1100. Okay, and it turns out that if you solve for this, the math is going to give you something like 0.0015, approximately 1.5%. Okay, so far so good. That's solving for the implied price. Now let's do the second part. How the question was, imagine that you found out, because you're an excellent analyst, that you think that delta is now not equal to 1.5%, but it's equal to 0.5%. Okay, so delta is below what the market thinks it is. Okay, so you have a different view on the dividend. Okay, that means you're also gonna have a different valuation for the forward, right? Your valuation for the forward is gonna be based on what you think the dividend yield is, right? So that's your valuation. Okay, well we're gonna just apply the formula, but now we're gonna replace delta by your value of delta, 1100 times exponential 0.05. Interest rate, we'll still agree on the interest rate, hard to disagree on that. Minus now 0.5% here, right? That's your view on delta times 9/12, and that gives you a value of 1137. Okay? So you think that the forward is actually a lot more valuable than it actually is. Why? Because the forward that's quoted on market, we saw, or we are told, is at 1129, which is below 1137. So what's going to happen is that you think the forward is more valuable than it trades at. Okay? Why is that? Well, it's because the market thinks dividends are going to be 1.5%. You think dividends are going to be really low, almost zero, 0.5%. So the market values dividend a lot more than you do. And so they're going to want to have the stock right now rather than want to have the stock later. Okay? So they rather have the stock than the forward. You know better than this. You know that, the stock actually doesn't bring you anything because dividends are so low. Okay? So you know that having the forward is going to be actually slightly better than not. Okay. So that's the first part. The second part is, can we use this to our advantage and build an arbitrage? Okay, well, let's see. If you want to build an arbitrage, we know that you think the forward quoted forward on the market at 1129 is underpriced. What you do is something that's underpriced, you're gonna buy it. Okay? You're gonna buy it. And how are you gonna pay for it? Well, you're gonna pay for it by selling the stock because you think the stock's not that valuable because, you know what? Dividend's not that high. Okay, so let's just try to build our arbitrage and see where it takes us. Okay, so we have 2 time periods, today and tomorrow, basically, and we're gonna, as we said, go long the forward. Go long the forward, usual nothing today. And now at maturity, well, I'm gonna receive 1 unit of the stock and I'm gonna pay for it at market price, which is the forward price, 1129. Okay? So far, so good. Now, if I want to build an arbitrage, I want to make sure that I'm going to have positive dollars at every point. I have positive dollar here and positive dollars here. Where we're going is I'm going to show that there is 0 here and something positive here. Okay? The one thing that I have to be careful is that S cap T is not known. I don't know what the stock market's going to do in 9 months from now. So I want to eliminate that S cap T, eliminate it from the problem. Okay, so let's see how we can do that. So I need here to have something that has payoff of -1 times S cap T. How do I do that? Well, I'm going to short sell the stock. If I short sell the stock, I'm going to receive some cash for selling the stock. That's like roughly equal to the price of the stock, so that's $1,100. And once I short sell the stock, what we've learned here, short sell stock, that you're gonna have to buy it back, to give it back to its owner at time cap t. Okay, so that if you borrow 1 unit here, you're gonna have to give back 1 unit. Except that when we have dividends, if we borrow 1 unit, we have to repay 1 unit plus the dividend to the owner, still at the future price, right? That's when we're gonna buy it back. So that's not gonna work, because here I want 1 unit, but I have more than 1 unit. How are we gonna do? Well, we're gonna short tail our position. We're gonna short sell less than 1 unit, so we actually have exactly 1 unit to buy at time cap t. Okay, so let's just erase all this for now. And so I'm gonna actually short sell a tail position. So I'm gonna do a short sell a little bit less than 1 unit, such that next period I'm gonna have to repay exactly 1 unit. That's 1 unit exactly. Okay, so that's equal to minus S cap t. Okay, so how much does it pay to short sell the stock? Well, 1 over 0.005, right? Because the dividend, you know, the dividend is only 0.5% times 1,100. So that's how much money you get. That's equal to roughly $1095.88. Okay, so let's see where we are at now. If I keep score, today I received $1095.88. Tomorrow I receive the stock in exchange for the forward price, that's $11.29, and then I've short sold the stock. So that's equal to minus $11.29. So right now I make a payment in dollars. I receive some money today in dollars, and I make a payment next period. But that's not an arbitrage. An arbitrage is something where there is always positive cash flows and sometimes zero cash flows. So what's going to happen is that I'm going to try to move this cash over here. How can I do that? Well, I'm going to lend money. I'm going to invest in a risk-free rate. Okay? So I'm going to basically buy a government bond. That's the second part of the arbitrage strategy. I'm going to bring it over. All right, so let me clean this up real quick. I've shown you where we're going. All right, so let's buy a bond. How much of a bond do I buy? Well, I invest exactly how much all the money that I have from short selling the stock, and that means that next period I receive my principal with interest. $1095.88 at a rate of 0.5 for 9 months, and that turns out to be, well, 11.37, right? Okay, now I can add everything up. It means I have 0 here, and then, or rather 1095.88 minus 1095.88, and here I have I received the stock, I pay the forward price, that's 11.29, then I repay the stock that I've short sold, and I receive my bond investment 11.37, and that gives me roughly $8 in profit. Okay, so sorry about that. If I want to zoom in here a little bit, what have I done? I've gone long the forward here, then I've short sold the stock because I knew that basically I was going to receive a stock, so I could just give it back and borrow against that stock I was going to receive, and then buy a bond, and that was my arbitrage. How did I get there? Well, I got there because I knew that the forward was cheap. So I was buying the forward with respect to my valuation of the forward. So basically here I buy cheap, and then here I sell what is basically my no arbitrage forward, which is also known as a cash and carry strategy, or in this case a reverse cash and carry, because I sold it. Okay, and then that's an arbitrage because here 0 zit and here positive, so we've basically won. Okay, well, that's it for this. Let me know if you have questions, and I hope this has been helpful. Thank you.